Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis, and the learning module on topics in long-term liabilities and equity. You would think with the learning module with this title would include massive discussion on bond and stock issues. But one of the first sentences in this learning module tells us that these topics are covered extensively in the prerequisite readings, not to mention that there are, 8 or 10 fixed income learning modules, about the same equity learning modules in level 1. And then, of course, we expand that in level 2 and level 3. So this really ought to be called other topics in long-term liabilities and equity. And so there are really just two focuses here. Instead of outright purchasing a long-term asset with a bond or a stock issue, we're going to go ahead and lease it. Instead of worrying about salary expense, paying our executives, what we're going to do is worry about giving them the right to buy shares of stock. And so those are the two focuses here on in this slide deck. So look at that first one. We're going to worry about leases from both the lessor and the lessee perspective. Then we're going to go ahead and switch over to defined contribution, defined benefit, and stock-based compensation plans. And then we'll talk about share-based compensation in the last few slides. So let's go ahead and start with leases. Now, what did I say just a moment ago? Let's take a company like Milton Hershey. What does Milton Hershey do? Milton Hershey wakes up every day and issues a bond and buys a long-term asset, a chocolate-making machine. But sometimes Milton Hershey says, you know what? I don't want to issue $1 billion in bonds to buy that asset. I'm just going to lease it from somebody else who either owns that asset or who can construct that asset for us. So what we do is we take possession, physical possession of that asset. We're going to call it a right to use asset. And then we sign a legal and binding contract saying that, we're going to go ahead and pay you over time. Now, it could be just super simple where we say something like, hey, all right, here's an asset. Let's say it's worth $1,000. And what I agree to do is I'll agree to pay you $200 a year for, let's say, 6 or 7 years. And after that 6 or 7 years, then life is over. Our relationship is over. You take possession of the asset. Or there can be some complexified terms in that lease agreement in which it says something like, during the life of the asset, I, who has the right to use the asset, I could just turn around and say, you know what, I really want to buy this asset today. And so that ownership then would change hands legally and explicitly. So these leases can be really simple or they can be more complex. In fact, some leases can be even more complex than a bond issue. So what do we need to take away from this first slide? So, some terms there in the first arrow point, but then we're going to make periodic lease payments. Two types of leases. Look at the blue box over on the right-hand side. This is the simple one. An operating lease. What does that sound like? Operating. It's just kind of part of our operations. And what we're going to do is we're just going to agree to make those, what did I say earlier, $200 payments for 6 or 7 years. On the other hand, we have these more complex leases, and the terms are finance lease, that's the international term. Capital lease is the US GAAP term. But what the finance lease does is it transfers substantially all the risk and rewards to the owner of ownership to the right to use entity. So these things show up on the balance sheet. So there's a really good exam question. Operating leases do not. Finance/capital leases do show up on the balance sheet. All right, here are some good exam questions. So let's take a look at this from the lessee's perspective. Just skip down to the bottom row, operating lease. All we do is, what do? We make that $200 payment. So that shows up on the income statement and it shows up as an operating cash flow on the cash flow statement. That's just super simple, right? But let's skip up to the top. So the finance lease or the capital lease on the balance sheet, we report this as an asset on the left-hand side, and then we report it as a liability on the right-hand side. What we need to do then is amortize this leased asset and we need to recognize the reduction of the lease obligation. Excuse me. Now, I'm not sure this would be a good exam question, but this might help you understand a little bit more about leases. You would think that the accumulated amortization and the reduction in the lease obligation, they would kind of offset each other. But the way that these accounting rules are set up is that you can amortize over a certain period. It's usually straight line. And then you can reduce the lease obligation over a different period or different amount. So those two things don't exactly offset each other over time. Then over on the income statement, we're going to go ahead and report an interest expense, kind of like it's almost like a bond issue, right? When we issue a bond, we have an interest expense. So this finance and capital lease, it looks an awful lot like a bond issue. So we report interest expense, and then we have to amortize, of course. Now, over on the cash flow statement, the reduction of the lease obligation, that, of course, is a financing cash flow, and that's under both the international and the U.S. standards. But look down at that bottom portion there. This is important. The interest expense is either operating or financing under the international standards, but it's an operating cash flow under US GAAP. So that's probably the exam question right there, not to mention just the difference between operating and finance leases, but that section right over there in the bottom right-hand gray box. Here's just a quick example. From Nike, what are we doing? What is this? 5 years worth of operating leases, 5 years worth of capital leases. Notice that Nike has, what is that, $4 billion or so in operating leases, but only, just a fraction of that under capital leases. Please make aware that this says note 15. So at the end of this slide deck, we're going to talk about disclosures. The Institute is always big on, no matter what we're doing, whether it's the policy statement, monitoring and reviewing and updating, well, the accounting standards gods out there, they're the same way. They say something like, okay, put it explicitly in the financial statements, and then you need to talk about it somewhere else. So go ahead and disclose it in here. Well, this is note 15 for Nike. Nothing really interesting about this other than you get an historical perspective, and you see that operating leases for Nike are way more than capital leases. All right, how about from the lessor's perspective? Here, we need to look at two different cases. So look over on the far left column. When the present value of the lease payments exceeds the carrying amount, or when the present value of the lease payment equals the carrying amount. All right, so let's go ahead and go through these. What we're going to do is make sure that we find the differences between these two. I imagine on an exam, the Institute would give you the present value of the lease payments and the carrying amount. It might give you those in two different sentences or two different parts of a table, and you'll have to determine whether they're equal to each other or if the present value is greater. All right, so what happens here on the balance sheet? Well, under this first case, we remove the asset and we recognize a lease receivable because we're transferring the ownership, over to the lessee. Now, look, under this one here, under the finance lease, when they're equals, we're still removing the asset and we're still recognizing a lease receivable. So balance sheet, that's just exactly the same. Income statement, skip down to the bottom one. We're going to report interest revenue. And what are we going to do here under when there's equality, we're going to report interest revenue. So those are the same. But when that present value exceeds the carrying amount, we need to report that profit on the sale. So there's the difference right there. Now, over on the cash flow statement, this is super similar to what we just described. The interest portion, that's operating or investing under the international standards, operating under U.S. standards. And then the receipt of the lease principal, that's an investing flow. So the finance lease, that's the same as it was on the previous page with those exceptions that I just described. How about the simple one, the simple operating lease? We retain the asset, you report the rent income, and you depreciate it, right? So we're amortizing that right to use asset because from the other perspective, because it's considered to be an intangible asset. All right, skipping to the second LOS here, let's go ahead and ask ourselves the question, all right, we have all these employees and we're going to provide them with a retirement benefit. The question is, how do we report that on our financial statements? So there are two kinds of retirement plans. You know this, I'm sure. There's the defined benefit plan, and here's back to the defined contribution plan. Point of reference, most universities use a defined contribution plan. This is what I have. So I contribute a certain percent of my salary. The university contributes a certain percent of my salary. And then I direct it. I say, you know what? I want to send those funds to Las Vegas every month. And I want whoever's there to bet it on the number 23. That's what I do every month. Of course, if I actually did that, I'd probably have $0 in my retirement account right now. But the point is, I get to direct it. Now, of course, I'm not going to do Las Vegas and gambling, but I'm going to go to a mutual fund family and I'm going to say, hey, invest in a well-diversified portfolio of stocks and bonds and whatever else they can come up with. All right, so what happens then? The employer contributes that fixed amount, and that is an expense. The only thing that shows up then is that it decreases cash right on the balance sheet. No future liabilities. If I do send that to Las Vegas as the employee, and on the day I retire, I have $0, well, I can't go back to my university and say, hey, what happened? What happened? I have $0. They're going to say, oh, Jim, that's a defined contribution plan. We really don't care what you did with it. And we're really sorry that you don't have any money, but there's nothing you can do about it. Defined benefit plan, on the other hand, work in a similar manner. I may contribute as the employee, but mostly the employer contributes. Maybe it's 100%. Maybe I contribute 0%. But then what the employer does is hire a pension fund manager. And that pension fund manager then takes my money and the employer's money and invests it. Now, if they go to Las Vegas and invest it on the number 23, and on the day I retire, if I have $0 in there, then the employer is responsible for paying me, right? Defined benefit. So those are specific benefits at retirement, usually based on, maybe like the average of the last 3 years of my salary multiplied by the number of years of service. There's some equation. We'll do a little bit more of that in level 2. Now, what this means then is that, let's suppose that I'm a 25-year-old college professor and I'm going to work 40 years. So what the employer has to do is the employer has to take the present value of all that, right? Starting in, let's say, 40 years from now, and I'm going to live another 40 years, let's say, take the present value of all that. So we need to estimate those pension liabilities, not to mention estimate the value of those pension assets that the pension fund manager. All right, so what happens then over time? There are gains and losses, right? And this leads to a funded status. And this is always fascinating for me. I'm going to go ahead and editorialize now. This has nothing to do with the LOS or the exam. If you're regular readers of the Wall Street Journal, you never read headlines that say, now you guys know I use, this fictitious company, Jim's Concrete Company. You never read Jim's Concrete Company, $10 billion surplus in its pension plan. Most of these things have a funded status that is not a surplus, that is a deficit. Nevertheless, let's get back to the exam. I think what the Institute will do is they'll say, hey, here are the plan assets. Here's the present value of the liabilities. Which one's greater? They'll probably never be equal. Maybe on an exam they would be equal. That would be a fully funded status. But typically the liabilities exceed the assets, so that would be a deficit. All right, here's a great exam question. I'm going to show you this quickly here, and then I'll come back. Look at, under the international standards, 3 general components. But under the U.S. standards, there are 5 general components. And so what happens here is that all these things are covered with maybe one exception, and in both of them explicitly, but you'll have to decide where they go. And so that's probably the good exam question. So back to this slide on the international standards. So we have three general components, the service cost, that's all this, whatever service means, net interest expense and net interest income, right? We've got interest going out, we've got interest coming in, so there's that net. Notice the bottom orange bullet point, recognized in the profit and loss in the period incurred. That's probably a good exam question. And then this third category, remeasurements. This is other comprehensive income. So these are changes in all of the assumptions, like, oh, you know what? Jim's an employee. He's 62 years old. And we thought he was going to retire when he was 65, but he just told us he's working till he's 75. So they'll have to readjust all that. How about another one? Not to be morbid or anything, but let's suppose I'm 62 years old and I'm planning on working till I'm 67, but I come to the employer and I say, hey, I'm just diagnosed with this terminal illness. I have a week or two to live. Well, we have all these changes in the assumptions. So that will be recorded as an actuarial gain or loss. Plus, we have to consider the actual return on those plan assets. I mean, think about it. Suppose for some crazy reason we go to Las Vegas and we take, $100 million and bet it on the number 23 and we lose. Well, that's a minus 100% return. Now, of course, we're not going to do that. I'll repeat that again. But if we invest in the S&P 500 index and that falls by 10%, we need to make sure that we return this. Note, remeasurements not amortized into profit or loss over time. Now, under the U.S. rules, we separate the service costs and the interest expense and this expected return on plan assets. So that expected return, and we'll talk about this, I think, at length in level 2, if not a little bit more later on in level 1, where we need to come up with some model to compute that expected return. Maybe we'll use the capital asset pricing model. Maybe we'll use the arbitrage pricing theory. Maybe we'll use Jim's pricing model to come up with a return on assets. Maybe we'll use the Las Vegas gambling model to come up with an expected return on plan assets. And then we have historical service costs. This goes into OCI. And then actuarial gains and losses, just like we said earlier. But look at this. This is typically amortized over time. So I think it's probably a good idea to memorize the difference between the 3 and the 5 between the two standards. All right, let's move on to these stock-based compensation plans. What can we do as a good board of directors? We can say to our executive leadership team, what we want to do is we want to align the goals of the business, right? What are the goals of the business? Maximize shareholder wealth. We see that in rising stock and bond prices with the individual executive's personal goal of always making decisions to maximize their own end of period wealth, whatever that end of period is. So what boards do is they say, you know what, if our stock price today is $100, we're going to go ahead and give you the right, but not the obligation to buy a ton of shares of stock at $150. So those options then are worthless today, right? Why would you buy at $150 as an executive when you can go and buy at $100? So then this aligns the goals. The executives then make wealth maximizing decisions. So all of a sudden, after 3 or 2 years, the stock price is now $300 or $400 a share. Now all shareholders are happy. The alignment of the goals has been achieved, and so everybody's happy. And so the question then becomes, how do we report these stock-based compensation plans on our financial statements? Well, what we need to do is we need to measure the fair value of that equity instrument that has been granted. And we're going to have just super conversations in level 2 using the Black-Scholes-Merton option pricing model in which we value these stock options. So right now, I wouldn't worry about that Black-Scholes-Merton model, but I would be prepared to answer a question that says, oh, we need to value these some way, and we're going to use some model, whatever that model is. That expense is recognized over the vesting period. Now, what typically boards of directors do is they'll say, you know what, we'll grant these stock options to you today, but you cannot exercise them for 3 years. That's a vesting period. Or we'll allow you to buy shares of stock at let's say, a 10% discount, but you're not allowed to do it for 4 years. So there has to be a vesting period, which means the executives then, they work for 3 or 4 or 5 years, and they fall in love with the company. They don't want to leave the company. And so this is one way that the board then tries to ensure that executives are going to be around for the long haul. Now, what happens after that vesting period and the executives either buy those shares or exercise their option? What happens then is that those new shares are issued from the treasury stock or those authorized shares. What this means then, if new shares are issued, this is going to dilute for existing shares, which impacts the earnings per share calculations. Now, this is not a big deal for these huge corporations. If you're regular readers of the Wall Street Journal, and you should be, you'll see that these really, really talented men and women who are chief executives, they might have an income of $40 million in a year, but 35 of those are from the exercise of those stock options. And that $35 million pales in comparison to didn't we have just several companies out there who exceeded the $1 trillion market value? So do 35 million divided by a trillion. And so, yes, from an exam standpoint, remember this dilutive effect. From a practical standpoint, from these larger corporations, it's probably immaterial. All right, how about this last LOS about disclosure? The international and the U.S. standards boards, these individuals, they love disclosures, of course. So they're going to say, just whatever you do, just let the bondholders and the shareholders know. But here's a list of some important disclosures that are required: carrying amount, cash outflows, interest expense, depreciation charges or amortization charges, and additions to the right of use assets. You can also disclose any kind of a maturity analysis, lease activity, lease imposed restrictions, sale and lease back transactions, just kind of anything that would be relevant, that would have an impact on, let's just go ahead and take a broad category here. Financial ratios. As good financial analysts, we're trying to figure out the right-hand side of the balance sheet in relation to the quality of the assets on the left-hand side of the balance sheet, in their ability to generate cash flows over on the top right of the cash flow statement. So anything that's relevant, I think, is a good one. The lessor disclosures, these are probably a little different for finance, the more complex leases, and for operating leases there. I'm not sure if there's anything too terribly interesting there. How about the post-employment plan disclosures? Plan characteristics, how the plan impacts future cash flows, net pension asset and liability. Nature of benefits, regulatory framework, governance, risk. All these kind of make perfect sense here. I like that third diamond point there. Sensitivity analysis based on those assumptions. I always tell my students, and I make my students do this fairly regularly, put together a simple old Excel spreadsheet and say, what happens if interest rates go up? What happens if interest rates go down? In fact, I just gave them an assignment on bond immunization strategy, in which they had to use Excel to show that the future value, when the duration of a bond equals the investment horizon, that future value is exactly the same whether interest rates go up or down. So that's kind of what's going on there in that diamond point. And then under the shares-based composition, the description of each, right, whether it's an option, details about the option, all that kind of good stuff. And that takes us through those learning outcome statements. So I want you to go to the learning module. There are 14 or 15 questions there. Some of them, it'll look like you'll need your financial calculator because the 3 answers are numbers, but you really don't. What the Institute will ask you is, here's some things, what should it report? So you just have to pick from among those 3. Funded status, is it this one or that one? So I think you should be okay doing those, working through those problems. So hey, thanks for watching. Have a great day and good luck studying.